Welcome to MacroHive Conversations with Bilal Hafiz. MacroHive uses natural and artificial intelligence to educate investors and provide actionable insights for all markets, from rates to FX to commodities. For our latest insights, visit macrohive.com. Before I start my conversation with this episode's guest, I have 3 requests. First, please make sure to subscribe to this podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave some nice feedback and let your friends know about the show. My second request is that you sign up to our free weekly newsletter that contains market insights and unlocked content. You can sign up for that at macrohive.com. Finally, and my third request is that if you are a professional or institutional investor, do get in touch with me. We have a very high-octane strategy and analytics offering that includes access to our world-class strategy team, market views, AI models, and much, much more. You can email me at bilal@macrohive.com, or you can message me on Bloomberg for more details. Now, on to this episode's guest, Mark Farrington. Mark is a global macro and geopolitical strategist and author of the Watchtower Reports, which covers topics ranging from geopolitical risk to Bank of Japan monetary policy to US dollar dynamics. He previously served as managing director and portfolio manager of the macro currency group at Principal Global Investors, where he worked for 15 years. Before that, he spent 17 years in the Asia-Pac region, primarily with Bankers Trust. Now, on to our conversation. Greetings and welcome, Mark. It's fantastic to have you on the podcast show, and it's great to reconnect after so many years.
Yeah, it's good to see you. You're looking much better than I am. I think the years have been kinder to you.
You're too kind. Well, I mean, for the benefit of our audience, it'll be great to learn a bit more about your origin story before we get into our conversation on the world. So I'd like to ask all of my guests something about what they studied at university, and was, in your case, was it inevitable you would end up in finance and then on the buy side and your key career milestones until now?
Okay, sure. Well, my educational career is sort of bifurcated into 2 parts. I studied international finance at the undergraduate level, where, being born on the west coast of America, we had a very sort of Asia focus. So I did international finance with a focus on Japan's, manufacturing miracle and China's open door economic policy, which were the 2 big themes there in the early 80s when I was entering university. And then later I went to LSE and did a degree in international relations and with a focus on geopolitical risk and strategy, much later in my career, as I became, aware that geopolitical alpha was sort of the next big event that professional financial people needed to have a handle on in order to make money. So those are the 2, points of education, formal education. But I have to say, I would describe myself as an experiential learning person. I've learned everything by being based in different countries around the world and a sort of pioneer in the emerging markets and working for British institutions, American institutions, and based in Asia for 17 years. So I really feel like I'm a product of my environment rather than my formal education.
No, that's fantastic. And, you write some great, research and analysis in your Substack note, Global Watchtower. One of the themes that you've really picked up on recently has been this idea of systems rivalry, the US approach versus China, this idea of dependency as a weapon. Can you elaborate what you mean by that?
Yeah, sure. I think that and from way back to the university years, my entire focus in financial markets and economics was always this relative story. What the difference between capitalism and socialism and state-owned economy and free market economies and strong industrial policy or no industrial policy. So those relative system features were always a keen interest of mine. And I've watched with interest over the last 10, 15 years or so, this experiment where China entered the WTO with everyone having sort of the best intentions, both those in the West who were, nurturing China for an early entrant and China's commitments that it made in the beginning. And so we were all watching to see whether they would conform, adhere, be a benign actor within the global order or not, or whether they would try to exploit it. Because, even if you were based in Asia through the 80s and 90s, you already understood that everyone in Asia was a mercantilist. So even our closest allies, we spent 15 years, bashing the Japanese, trying to open their markets, and they were our closest ally. So it was not so much an issue of enemy or rivalry. It was just this philosophical different view about mercantilism. And I think then what has happened and what has manifested now is China has focused on building these deep dependencies, and in particular at the very base of the supply chain, so that the leverage is maximum. And then, had quietly, been building stock and supply lines and relationships that are quite deep without exploiting them. And then, unfortunately, now, in the form of retaliation to the trade war, which was started by the Trump administration, they've shown their cards on this. And I think that it will backfire. It will no longer be an effective policy because nobody wants to have, dependency used over them as a lever for either economic or security coercion. So I've really been struck by China's decision to reveal that card. And I think they kind of probably wish they hadn't by this point.
And on the systems point about, capitalism versus socialism and so on, I mean, one this was an argument from the Western side, which was that as China develops economically, then naturally it will start to develop democratic institutions and become like a liberal democracy like the West and so on. I mean, why do you think that didn't happen?
So it's a good question. I mean, honestly, living in Tokyo in the late 80s and just looking for incremental gains in Japan, adopting Western institutions and Western values, I had zero expectation that China would. My first trip to China, I think, was in 1988. It was still a complete communist country. Everyone wearing the blue tunics, no automobiles on the road. It was all bicycles, etc. There just wasn't a chance in hell, really, that they were going to then flip overnight and become capitalist Western. I think the Asian culture is very strong. I know you lived in Singapore for a long time. You know what I'm talking about. And it's successful. It's not an unsuccessful culture, it's an extremely successful culture. And it's conservative in a lot of ways that go beyond our Western definitions of political systems, capitalist, socialist, whatever. I think that the communal Asian philosophy is as strong as a communist or a socialist one. And I just never saw any incentive for China to change. And the West didn't ever really give them one. I mean, they fudged all of the entry requirements for the WTO, and they fudged all of them again for the SDR basket inclusion. I mean, the West has just really not played hardball at all on this level, so why would they? I think China did what you would expect.
I mean, we'll come back to, gaming out how China's strategy could backfire. But before we do that, I just wanted to ask about China's gold strategy, because, the rally in gold this year has been a huge story. Many people have now sort of started to jump onto it in the, people are framing it as debasement and so on. But, and China's obviously involved in this all. I mean, what do you think is going on there?
Well, I think it's a really interesting topic, and I don't want to imply that I have a conclusive answer yet. I have a few theories, and one of my theories is that China is frustrated with its attempt to internationalize the RMB. I think it became frustrated after all of the effort it made to be included in the SDR, and creating a panda and a dim sum market in Hong Kong, China. All of these efforts that had previously been successful in helping to increase circulation and demand for the currency, for reserve currencies, like in the case of the euro, etc., they weren't exactly happening. They're certainly not happening with ease. And what China, I think, discovered is they're not ever going to happen without opening the capital account. And I think that they have this hard discussion internally saying, is it worth it? Do we want to risk everything and open the capital account? Because if they did, for sure, you would get a take up of the RMB, at least in line with the euro. But I think they've just made the decision it's not worth it. I think the CCP needs the control. The capital account would change everything. And so they continue to try to build these hybrid structures like CNH and North Connect and even the ECNY with no convertibility, etc. So I think they've perhaps settled on gold as a country agnostic, neutral quasi-currency that they can build some international architecture on, maybe either through a gold stablecoin or other forms of using gold as a collateral to back some of the other tokenization and digital currency activity that's clearly going to start to grow globally. Maybe, for example, offering invoicing in either in the future when we are fully digitized in eRMB or e-gold, and then offer your trading partners the choice. So I think their interest in gold is very strategic. I think everyone else's gold is a little bit opportunistic and built on some of these rather unconvincing arguments about de-dollarization and the collapse of the West.
And speaking about financing, I mean, China obviously has financed lots of different initiatives around the world, the Belt and Road. They have all these different institutions, various development banks and things like that. How do you see that within this system of sort of dependency and internationalization of renminbi? Because much of the lending seems to be in dollars, as far as I can tell.
Exactly. And I think that's also one of the sources of their frustration, is because they built these institutions. They're all headquartered in mainland China. They transfer Chinese expertise and have majority ownership and long-term leases and every other possible, lever of control on these things. But in financial terms, they ended up having to have a lot of the loans, denominated in dollars, because that was the currency that the borrowers could generate to repay, basically. So, yeah, I think they would like to see that shift. I think with the SCO development bank, they're going to be a bit stricter on this, and it could be because there is much more military trade and military infrastructure that's done, and so the higher security allows them greater leverage in terms of dictating terms. But yeah, I think that's just I think it's just a mere reflection of the world we lived in. A lot of choices for dollar as the reserve currency or the payment currency or whatever, it has nothing to do with alignment to the US or belief in Western philosophy versus Eastern. It's just the lowest cost, most efficient way to set up a transaction. And China hasn't changed that trade-off yet. It wants to, but it hasn't yet.
And then in terms of the financing, especially in countries like, in continents like Africa and then other parts of Asia and so on, even Latin America, I mean, some people are trying to analogize that to some of the Western colonial times, where there's all this debt diplomacy and, all of those sorts of things that are a way to kind of enslave or control other countries. I mean, do you think that's a fair parallel to today, or is it, is it sort of more transactional than sinister?
Perhaps it has some similarity in terms of hoped for outcomes, but in actual outcomes, there are not too many similarities. I can't remember when you first started being based in Asia, but in the early 90s, for example, if you traveled around Southeast Asia and places like that, you were immediately aware of the increasing internationalization of the yen, because you would be going into market centers in Malaysia and Thailand and Singapore, and the retailers would accept cash yen notes right alongside dollars and right alongside Deutschmarks and things like that. And this, you would immediately observe the increased willingness and preference to hold yen notes during that period. Okay. We saw that, a brief moment of that with the euro, but as soon as the ECB decided to eliminate the 500 euro note, and all of the gangsters of the world lost their favorite black market currency, then that sort of declined as well. And I don't think I've ever experienced in all my travels, maybe you have, where people are happy to accept RMB notes. I think RMB in circulation is something like 1% of MO. Globally, where the US, it's 60%. I mean, think about it, 60% of currency in circulation is outside the US. So that preference is voluntary. It's driven by so many other things that have nothing to do with economic coercion and geopolitics. So I had this debate with one of my friends a few days ago. I think Africa, if dollarized stable coins end up being a big phenomenon that's dollarizing across Africa, I reckon a gold stable coin would be number two. And if that gold stable coin was issued by a Hong Kong stablecoin issuer, then that would be China's, external proxy currency that was in demand up there. But I just don't see it being RMB. It's dollars and potentially gold.
And, if we flip over to the US's relationship with China, I mean, we've had kind of a series of different kind of perspectives on China. There was kind of the early bring China into free trade, WTO, and so on. Then I guess with Obama, you started to get the Asian pivot. Then Trump won. Then Biden kind of refined that with a more specific attack on China's tech, and now we have Trump 2.0. So, the current administration's approach, or perhaps what's your kind of take of this evolution in the US's approach to China, and where are we today?
I think that rather than the change of administrations driving the change, I think it has been the reluctant and skeptical acceptance of the effectiveness of industrial policy. I think I've been lobbying Washington to adopt industrial policy since at least 2001. I can remember so many of my research trips to Washington and meeting with the State Department, with Treasury, to the West Wing, everyone, to say, look, Asia's not going to change. Japan's not going to change. And now you're opening up to China. They have industrial policy. They're dynamically updating their worldview every 5 years and retooling the industry that needs to be retooled so they can stay competitive. And the US is doing nothing. I said, you really need industrial policy. And there was so much pushback on that, I think, in the first 10 years. And then, right around the end of the Bush administration, partly as a reaction to the global financial crisis, but then also Obama came in and had a more interventionist mentality, particularly in domestic healthcare policies in the U.S. But I think was surrounded by different people that were more willing to consider that. And then I think the consensus for industrial policy started to come out of the Defense Department and the security contingents of Washington. As the rise in China clearly became worrisome. And then finally, the U.S. embraced industrial policy under Trump 1.0. And I think no matter who comes into the White House now, we'll continue with that. I think that this dogma of, we're a free market capitalist country, we don't do that, has now been completely broken. And now there's a kind of pragmatism out there, and it's just focused on outcomes rather than philosophical purity.
I guess it might be useful then maybe to compare, what's your sense of the US's current industrial policy? And then maybe we can compare that to China's current industrial policy. We're obviously just coming off the recent plenum, the 15th five-year plan. How do you compare or contrast the two?
Okay, that's good. I think that it's much more holistic under Trump 2.0 than it was under 2.1, because now we've had this data point of the pandemic and the lockdowns, where we discovered a whole host of supply line dependencies that we didn't even know we had, from everything from toilet paper to masks, to what could otherwise be considered quite trivial consumer products and things like that. So I think I think of it in terms of percentage of self-sufficiency. I think that, all of those little discoveries during the 2020 lockdowns, when suddenly the world was not sharing with each other anymore, we're going to try to get to something like 20-30% self-sufficiency. And then you move into this sort of relative competitiveness space of the industrial sector, and the lower industrial sector of the military, and the lower industrial sector of building, shipping, transport, et cetera. I think we're targeting 50%, self-sustainability. And then as you get into the high-tech space, the dual use and military use type of technologies, we're going to be targeting 85, something much higher. So I think of it in terms of percentages. We're no way America is going to 100% self-sufficiency on everything, but everything will be considered now in terms of how severe the pain would be in the event that it was cut.
And when you say America, is that America, the USA, self-sufficiency, or is it US and its allies self-sufficiency collectively?
That's a good point. I honestly don't know. I would say for NAFTA, we could first think in terms of NAFTA. I think it would be considered secure enough that it would be treated as, United States of America. So ensure that you have all those productive capacities within NAFTA. Europe and Central America and friendly North Asia, I think they're going to include them in plan B and backups and buffers. But I think it's that same degree security trend line that I'm talking about. On the military, there will be some things that will be 100% U.S. Self-sufficiency only. And then you get down to goods like maybe in the area of agriculture, for example, like that. I think that probably they would trust their trade relationships with Argentina and Brazil and things like that to remain dependent on certain types of agricultural products.
And then with President Trump's recent tour of Asia, which was capped by that, that summit with President Xi, he also came up with agreements in South Korea and other countries in the region, which seem to be quite strategic in terms of nuclear, submarines, where they're going to be built in the US and so on. What did you make of that?
Yeah, I think that trip, those agreements that were signed in ASEAN, and then the preliminary trips in Japan and with South Korea before he met with Xi, were so important for setting the stage and giving Trump the leverage that he needed in that meeting with Xi, because it showed that the U.S.'s traditional allies and trading partners in Asia are still more than likely going to remain aligned with the U.S. market rather than the Chinese market. I don't want to say aligned with the US versus China, because I don't think that's what the alignment is based on. I think it's based on the market access, and so they, of course, North Asia depends on the US's security umbrella, and so does the sort of second island chain, but Southeast Asia doesn't depend that much on the US security umbrella. So it's really maintaining that unfettered access to the US market. And so those are all established. I think the national security strategic interests signal that came out of those were the type of industries that were selected. Like, for example, with South Korea, biotech and AI, and I think energy, was it? So it was showing the three areas which were most important to the US, and the areas where they feel completely comfortable sharing IP at the highest level with South Korea. I think those were significant. South Korea, I think, is going to be drawn very quickly into the Indo-Quad and all of the security arrangements that are, evolving within the Pacific. So, that was a very successful bilateral with Korea, I thought.
And one thing I found in some of your writings is this observation that Japan is actually understanding the Trump administration and the new direction of the US better than almost anyone else. You talk about some BOJ analysis, a speech by Takeichi-san, the new prime minister. I mean, can you talk more about that? I completely missed me until you mentioned it, and then I started to read up on it. But I'll let you elaborate.
Yeah, I guess, my life is intertwined with Japan's for 30, 40 years now. So I feel very in tune with their view of the world as well as the US view of the world. And it just struck me, given how poorly I feel Europe and even Canada understand what the transformation that's happening in America. I mean, people on Australia, another country I lived in for 7 years, and I used to feel I was quite tightly aligned with the Australian worldview. They have just shocked me about their misunderstanding of the national security pivot that's taking place. But Japan didn't miss a step. It helped a lot that Abe completely redirected the LDP 10, 15 years ago in the right direction, and actually played a leadership role with the US and getting their head around framing the Indo-Quad, because the Indo-Quad was a brilliant stroke of diplomacy, because they found the right language and the right objectives to appear not to be directly countering China. It was free and open maritime transport lanes. And that gave everyone a rallying point that wasn't too militaristic and was connected to trade and peacetime type of activities. So I think there was a lot of work already done by Abe, so Takeichi could come in and refine the message and immediately find a welcoming audience. But from the BOJ, that was a complete left field shock for me to see, Deputy Governor Humino write this analysis of how you should interpret the tariff policy. And it was better than anything I'd read on any of the international relations blogs or, think tank podcasts or anything like that. But it was just basically arguing that this is a very holistic approach that the Trump administration is taking. And they view the domestic challenge, the international challenge, the twin deficits, and the rivalry of China and the war in Ukraine. They view it all in these holistic terms, related to the weakness that the U.S. has developed, and that setting aside the individual policies on trade or the individual policies on national security, if you strengthen the U.S., both in terms of all of the self-sustaining aspects of the industrial policy, but also in terms of its military might and projection, and I think of it more in terms of reduction of imperial overstretch rather than projection. Your projection of power becomes more credible as soon as you pull back from all of these areas where you didn't have that much control anyway, and they were draining your resources. So that's why it was not pure isolationism. The Trump national security policy were drawing from the endless wars and were drawing from regions of the world which were prone to constant conflict and just did nothing but drain resources. That actually strengthened the 2 or 3 areas where you do want to increase your power projection. So I think that you have to view the policy transition as total, because the Republican Party really has a total different worldview than the Democratic Party had. Okay, they did not trust in the international institutions anymore. They didn't trust on the old rules-based international order that people were counting on to deliver these goods. They knew we had to do it all ourselves. So that's why you have to view it holistic. You can't just focus on one thing like tariffs or one thing like, scolding your allies for not paying enough on defense, etc. If you look at it in totality, would the Trump administration is just trying to convince all of the allies and friends and partners of the world to adopt its worldview?
Yeah, no, that's a really good way of thinking about it, because it's very easy to get distracted by the theater of what's going on in the US and not realize what's going on at a bigger picture level. I did want to ask you, you mentioned the Quad, and we haven't talked about India. Obviously, India is a major economy, largest population, and so on. I mean, how does India figure in all of this? Because, since Trump has come in, with the tariffs as well, it seems to become more adversarial against India. India's obviously has more of a sort of nationalistic, government under Modi as well. So maybe they, in general, don't want to be part of too many sort of international alliances. But where does India sort of figure in all of this?
Well, I think it's a good question. I'm struggling with India myself too, and this is, I think, one area where the world is missing the leadership of former Prime Minister Abe. Abe, I think, managed that relationship between the US and India very well. He offered guidance and advice from both sides, and he helped to find a way that the US and India could be closer together. Because, of course, India has always been non-aligned, strategic autonomy, and a big nation that didn't necessarily fit into any of the other sort of programs that the U.S. was offering around the world. So it was not India's never been the U.S.'s enemy, and it doesn't generate any security dilemmas for the U.S. to manage. But also there was almost no way for it to really come closer together other than the transfer of people. You've seen a tremendous flow of high-skilled immigrants from India that have had a significant impact on the U.S. economy. So I think Japan solved that conundrum for the U.S. And now without Abe, I don't think the Trump administration has any go-to person to help them with the Indian relationship. And I think India can easily fall to the back burner for all the reasons I just cited. It's not core to the U.S.'s strategic interests, or at least it's not the major source of an issue right now. So I think it's probably going to fall on the back burner, and it will be up to India potentially to try to bring it back to the front. I think they will eventually get a trade deal, but it won't be some decisive trade deal that changes the dynamics very much. I think that India needs to decide what role it wants to play in the world. I think as a large major power, it can no longer just simply be the large population non-aligned country. It's got to do something a bit more than that and project some power and take some responsibility for regional security. We'll see how it responds to, for example, the Saudi Arabia-Pakistan security arrangement. That's a pretty big change of the dynamics in the Middle East. So I'm interested to see how India responds to that.
And one thing you've also written about is Western convergence. I assume that means kind of Europe, US. It kind of doesn't feel like there's much convergence going on. It feels like there's divergence. And even within Europe, like people are always prodding Europe to sort of, do something and it's stop, start. And, what do you mean by convergence? And is it happening? Are we missing it?
Yeah, okay, probably convergence created too optimistic of a sounding of a force. But what I meant by that is I had this view earlier in the year when Trump launched his Liberation Day that shocked everyone because, I mean, let's face it, he's not the best man to deliver bad news. He has no tact at all when he delivers, shock and awe to everyone. So it went down badly, of course, and everyone immediately reacted defensively. I think Canada is the one who is probably most traumatized by all this and has not recovered. But I argued eventually everyone will, and they will because they'll realize that Trump's bark is bigger than his bite. He's loud, vivacious, New Yorker. Focus on his actions and his good intentions, and eventually you can cope with all of the chaos that's normally around him. And then that convergence should manifest in the actions that people take. So I've been seeing one by one from Europe to North Asia to even Australia, taking these strategic decisions on things like critical minerals and military arrangements and enhancements, etc., that point in the same direction as the Trump worldview, the Trump administration worldview. So I think if you plot it like a scatter plot, there all of these little actions are starting to form this congestion around the same direction that the Trump administration came into in January and just announced carte blanche to the world. So that's what I mean by convergence. I think over time, the West and Americans, traditional allies, will accept the worldview that has now been articulated in shock form, everything from J.D. Vance's Munich speech to Trump's announcements on the trade war. The shock wears off. Eventually, people accept the worldview, and then they start to take the decisions for their own national interests. And that's why I wrote that about Japan, by the way. I mean, Takeichi's victory speech, she kept emphasizing self-reliance. Okay, we're taking all these measures to improve Japan's self-reliance. But every one of the measures were completely consistent with what Washington was asking them to do. So that's what I mean. It's about doing the right thing, but rephrasing it in the way that perhaps Washington should have phrased it from the beginning, and that gets us all back on the same track.
And just on Europe, I mean, it feels like everyone just beats up on Europe all the time. And people frame things as like China's got a policy and it's very clear. US has a policy and Europe just doesn't have one. And they're always going to fall to the wayside. I mean, what's kind of a more optimistic case for Europe? I mean, from what you say, actually, they seem to be slowly going down the route of what the US is doing. So perhaps that is implicitly some kind of policy. But it is this view that's US, China, and Europe's always kind of the side story that never quite gets it right. Is that fair?
Yeah, I've been reading with interest a lot of the papers that have been put out recently. Marvin Buff's piece on Europe and a number of others on Substack like Doomberg and Wall Street Journal, etc., with these very pessimistic views on Europe. And it can definitely happen that way. I mean, Europe is in a very vulnerable state. I'm not sure how it recovers. The traditional way would be, in a democracy, you get a change of government, you get a revision of policies, but we have some resistance on that level. Macron just will not, resign and go away, and he's clinging to power, no matter how much damage it does to the French economy. And the Germans continue to cling to a alternative energy and climate change type of policy view that's completely incompatible with the economic reality that's on the ground for its people and its neighbors. So, we're not very close to the tipping points on the two largest countries in core Europe. And as I've written for more than a year now, even pre-Trump, which is this thesis about rising geopolitical systemic pressure, a system with high pressure just produces disasters where all of the cracks and the flashpoints are. And the euro, the EMU, I should say, as a currency union, is one of those fragilities. It remains one of those fragilities. And I noted with interest the huge gold buying by Poland and Czech Republic, and threats of departure by Hungary and things like this. That the EMU crisis from 2010 and 11 didn't resolve all of the issues. So we still could have a day of reckoning that could be quite horrible, and it should manifest initially through euro weakness. And yet to see everyone trying to buy the euro on the de-dollarization theme, this is completely incompatible, I think, with the view of what the risks are. So I'm afraid I don't have too much more insight on Europe other than that, but I'm worried about it like everyone else.
You mentioned the dollar. I mean, do you have a view on the overall sort of dollar trend or its trend against different currencies?
Yeah, I think the dollar is still in an uptrend. I think that correction in Q2 was artificial because it was such a shock. Like I said, there are many different ways that the Trump administration could have delivered some of that news that wouldn't have produced such a shock to the financial markets. And I think that a lot of political capital got invested in that de-dollarization and fall of the Western system, and people are having trouble letting go. I think perhaps year end might allow a lot of them to draw a line under it and start afresh in January, because you can see it was a head fake in equities. It lasted like 2 weeks and we were back to full uptrend in equities. In terms of economic growth, everyone who revised down in Q2, they've all had to revise back up. So the only outstanding revision that everybody made was to the dollar view. And I think that the Fed hasn't helped the case, because I think the Fed has lost track of its reaction function, and so it cannot communicate with the market anymore. And we have far too much easing discounted, and that has delayed the dollar's recovery. But yeah, I think the dollar will recover and probably even set new highs, because the typical type of structural change that we would need to end the dollar uptrends is not there. The big structural dollar uptrends, they only end through intervention or a full, systemic crisis of some kind. They don't usually end through tinkering.
And you mentioned the Fed. I mean, one factor, I guess, for people expecting dollar weakness is this idea that the Fed will end up being very dovish, partly because of their focus on the labor market, and partly also because of political pressure as well, that they should be easing a lot more. Mirren, who joined the board, a Trump appointee, keeps asking for 50 basis point cuts and so on. We get Powell switch next year. So, what's your take on what the Fed will actually end up doing, rather than what you think it should do? And then also just what's your review of the Fed as a whole? How would you score it?
Well, I think the Fed, suffered a bit of bullying during the summer. It was not pretty, and the markets, penalized U.S. risk premium for that. But I think since Jackson Hole, neither Trump nor Besant have been a source of problem for the Fed. I think the Fed has done everything on its own. I mean, it's talking a story that I don't see in the data. I think other economists who are much smarter than I am have written about the stories in the labor market. I think the Fed is not paying enough respect to the fact that we can very well have an environment where there will be zero job growth, but an inflation problem. And it hasn't articulated how it's going to deal with that challenge to its dual mandate. And I think that's just negligent. The Fed is giving forward guidance only on one side of the risk. It needs to be given forward guidance on the other side of the risk, saying, well, we're taking out some insurance cuts now because we're concerned about the labor market. There is poor clarity here, and we're not sure that it will create enough slack in the economy to address inflation. So we may find ourselves in a situation where we're unable to respond initially to the weakening in the labor market. They should be giving guidance like that. That's part of their responsibility. And for that, I don't think you can blame that on Trump or external forces. That's just bad forward guidance. And these days, I'm quite critical of central bank forward guidance in general because they've just got too much wrong that now forward guidance has become a problem. The market doesn't know whether to respond to it or not because their track record is so poor. But they've been sort of conditioned that they're supposed to respond to forward guidance. So I think that's hard for the market and discrediting for the central banks.
And in terms of inflation risks, I mean, most people, most economists, most investors seem to think that the inflation dragon has been slain, so to speak. Tariff fee pass-through has only been in a sort of, just goods, hasn't really spread beyond that. Rent seems to be falling, so it seems like inflation is not so much of an issue. But from the sounds of what you're saying, you seem to think that actually it's too early to say that.
Well, yeah, I mean, I think that inflation's at 3% for a reason. There's some components rolling over, and there are some that are pushing higher, and the truce that was reached between U.S. and China and South Korea gives us a year for everyone to go out and hoard like hell critical minerals and all the things that China has threatened to cut off in the last 6 months. And so that hoarding is not exactly going to drive prices down. And so I don't see, commodity prices are not at some cycle high like they were in 2014 and ready to roll over with slower Chinese growth. I mean, that's what gave us a big deflation impulse, from 2015 to 17, is it was, the peak in a global commodity cycle that had run really hard for 10 years. We're at the opposite stage right now. We're at the bottom somewhere. So I don't know, you need a pretty poor global growth outcome to keep commodities this depressed. And the bifurcation of the global markets and supply chains should imply a lot more friction and less visibility on prices through the long lag times for investment in mining and minerals and commodities that there is. And we're still very competitive with China at the moment on the port issues. So the U.S. didn't exactly commit, like, we're not going to charge these fees to Chinese registered or made boats. I can't remember now. They just said, we're going to review it. So everything's reviewing. So we know there's going to be this immense investment in port infrastructure for the next 10 years. I wouldn't put it past Trump to continue to shock the market with announcements on all sorts of costs along the way to help fund that. And so that's going to push up the price of import materials too. So I don't know. I feel like everyone's betting too much on AI as a disinflationary force and not paying enough respect to a lot of these other issues, which are literally the antithesis to globalization. More friction, more fragmentation, risk of sudden, regulatory announcement change, et cetera. Absolute opposite of the big disinflationary force that took place during the Great Moderation.
Actually, speaking of AI, I mean, there's been a big kind of talk recently, at least in the media, around AI bubble. Is it about to burst or not? People are focused on the amount of spend on data centers. Do you have a take on that, or we can maybe sort of generalize in terms of the equity rally that we've seen? Has it gone too far, too fast, and so are we in for a period of, at the very least, consolidation, if not a larger correction?
Yeah, well, I can tell you myself what I've done as an investor. I mean, in the beginning of these themes, I bought everything along the development chain too. I bought the energy generators, I bought the data center manufacturers, the logistic and service providers, and of course the chip manufacturers. So, bought all along the chain like everyone else. And then as each one of those stocks popped and went up 50% or whatever, I was quite happy to slap myself on the back, book the profits, and be done, because they may or may not eke out enough earnings over the next 18 months to validate their multiples that they're trading online. But that's just outside my area of expertise. I'm trading the macro, I'm trading the industrial policy theme, and I've made the easy money during the first ramp up. What happens after this, I think, is going to be pretty hard sledding. I think we should leave that to the stock picking long short specialists out there rather than the macro guys.
And in terms of crises more generally, like some kind of systemic crisis, obviously we had the GFC, we had the COVID shock, we had in between that we had the European sovereign crisis. As macro people, we're always trying to look for the source of the next crisis. How are you thinking about that?
Well, I think that I have always had the view that this crisis would be driven by either inflation or volatility. And the reason inflation and volatility are the perfect catalysts for crisis because they cut across every single asset class and they cut across every single country. And so when we had the inflation episode, 22, 23, it looked pretty scary. And I think had it kept going, that could have been it. So I feel like the Fed got off easy, having to raise Fed funds only to 5% and getting inflation to roll over like this. And I think that that has a lot to do with the fact that so far, somewhat miraculously, the Ukraine-Russian war has remained contained to only Ukraine's borders, because there was upside risk, all through 2023 on that. And then, the fall of Syria, the peace deal in Gaza, the short bombing of Iran, all of these geopolitical events were unbelievably short and truncated. So it could have gone the other way. So I feel like we've just been pretty lucky, actually. The Fed got away with a 5% Fed funds rate cycle, lost a lot of credibility on inflation. And the market vigilantes did almost no work against the Fed. They seem to be completely absent from the market. So I think the second round inflation event, if we have it, will not be so easy. The Fed will not be able to break the back of inflation psychology by going to 5%. It's going to have to go higher. And surely in the next episode, inflation expectations will become disanchored. And that means their work will not only be harder, but they'll have to hold it longer in order to change psychology again. So I think the verdict is still out on inflation being the source of the crisis. Volatility is another potential danger because high interest rates were starting to break the back of the perpetual vol sellers everywhere in the world. But it didn't feel like at the time, but actually an 18-month inflation cycle and spike in rates is relatively short. So there's a lot of long-term structures that didn't get, called in. And so the vol sellers didn't have to pay, and they're still out there. They're still selling every vol spike. That conditioning is still there to try to sell. So if we did have some unexpected shock, either geopolitical or act of God, people forget 2011 where it wasn't war, it was tsunami, earthquake, and nuclear meltdown in Japan that drove the shock. And we had to have coordinated intervention and everything else to recover from that shock too. So a big vol event would, I think, have legs. It would run, and I know you suggested you might want to talk about private credit markets, which I'm not actually a specialist in. But if that is a first domino, and it can really trigger a few other markets and get general system vol higher, then vol still has the potential to be the catalyst for crisis. But otherwise, there's nothing on the immediate horizon, and I think I'm in the wait and see mode with quite defensive portfolio. I've taken profits basically on all my global equities and risk assets, and I'm sitting back and just waiting and watching.
And then how about a trade like the curve steepen trade? People have tried it a couple of times this year. Obviously, recently it's kind of gone sideways, if anything. But in some ways that does capture, so at least the long end captures many of the risks you're talking about. Do you have a view on the curve?
Well, I think it's probably a sign of hedging for sure. I think that the buying of gold was interesting. I thought as a macro and inflation hedge, because they took. If you look at a big balanced fund, survey type of outcome, you can see that they've taken the gold allocation. It looks to be mostly out of cash and sovereign bonds. So, they've swapped a 12% vol asset for a 16, 18% vol asset on this debasement thesis. And, I think that's not going to work out. And I think that the people who have done that with a traditional portfolio, there's just as many others out there in the private equity and private credit and long duration, non-bank, non-mark-to-market world, where they have a whole host of non-mark-to-market assets that don't trade. I think they're buying treasuries as their hedge. They're not going to buy gold because they've got too many things that look a bit like gold. So I do think that there is a flight to quality bid in the treasury all along the curve. Not enough to make it look inverted, like signaling a recession or a risk event, but enough to block what would otherwise be this rising risk term premium, I think, that should be in the marketplace. So it should be showing up in other bond markets, like maybe in the European bond markets and in the other Anglo-Saxon bond markets, and areas which traditionally don't have the strong flight to quality flow. But I can't explain treasuries other than that. It doesn't look right, but it's a big, deep market. So I trust that there's a flow out there somewhere, and it's just one that I'm not that close to.
No, that's great. Now, we've covered a lot of macro now, and I just wanted to round off with a couple of more personal questions. One is, obviously, you've had a very long career in finance. What's the best investment advice you've ever received from anyone?
I think that's a good question. I think I had some fantastic mentors early in my career. In 1992, when I went from the sell side to the buy side, they helped me a lot because basically most people don't make that transition. And so they intervened to make sure that I did. I think that the dimension of time is probably something that I spend more time on than maybe others don't, because I think it's easy to visualize, what might come next, what are the big themes, what's a good investment thesis, et cetera. It's really hard to know the sequence of what's going to happen over the next 2 or 3 quarters, or the idea that you have in your head that you want to put in the portfolio tomorrow, but it's actually not going to be relevant for 9 months. So really understand conceive the idea by all means, research, prep it, get it ready, but then spend a lot of time after that analyzing the dimension of time about when it's really going to slot in and be ready to be discounted by the rest of the market. So that dimension of time is a really important one. And then I would say also, I've been a liquid markets investor my whole life. And so I would say that people who are in liquid markets trading should not confuse, our skill set with a long-term investor skill set. We're not Warren Buffett. We're not investing in valuation and holding until we're right. You have a lot more responsibility to get it exactly right, and then you have the responsibility to cut it quickly when you've discovered that you're wrong.
No, that's great. 2 great pieces of advice there. Some of our audience are young, and many of them are at college. They're going to graduate or have graduated already. What advice would you give to youngsters as they leave university and enter the real world?
Okay, yeah, that's a good one. I think that I always believed, because believe it or not, I think that our generation have already lived through one challenge. I mean, the rise of the machines actually started around 2000, but we call them quants. So now we've gone from quants to tech to now AI. So it feels like the human machine rivalry has been going on for 20 years in my case. But I would say that if you focus on idea generation, bespoke content providers, visionaries, this type of expertise, it's never going to be replaced by AI. AI is going to augment that. It's going to accelerate that. It's going to, make that profitable. But you want to focus on those type of skill sets and those type of jobs, because they should have more staying power in a world of AI and potentially AGI.
No, that's great. And I did want to ask you about books. Were there some books that really influenced you or not over your career, or perhaps recent books you've come across that you'd like to recommend to our audience?
Okay, well, I consider myself to be a bit of a systems analyst. I mean, I think my investment process that we developed in the 90s that proved so well at predicting financial crisis for the 2 or 3 decades after that was based on analyzing, the global financial system as a system. And then I've taken the same approach with geopolitics and studying what's called the international system. And this is a book and a thesis that was put forward by a guy named Kenneth Waltz way back in 1979, and sort of revolutionized the school of realism in international relations. And it's to look at the international system as a system of anarchy. So, and then there's a whole thesis and theory about how to predict states' actions accordingly. So I recommend that book highly. Kenneth Waltz, Theory of International Politics, 1979. And then two other big system books are, of course, The Black Swan by Nassim Taleb, and then The Tipping Point by Malcolm Gladwell, which is, I think 2000, something like that. But those helped you look at something big, somewhat difficult to get your head around, that then hone in on the signs that tell you that it's about to have a big systemic shift. So I'd say those are systemic risks. In terms of country books, I can't recommend enough this book on China called Weaving the Net, Conditional Engagement with China. It was written by James Shin back in 1996. And for those that don't understand how badly the US forecast the rise of China and how, negligent the early entry into WTO was, please go back and read this book. It was from a policy insider in Washington who knew Asia extremely well, wrote this book in collaboration with a bunch of other extremely important thought leaders, and warning the US government about what to do about China in 1996. And if you read it now, it's literally a roadmap to where we are today, with the US having done everything wrong, So fantastic book, have a read. And then forward-looking books, the ones that I'm reading at the moment, I'm reading The Meiji Restoration, which is by Beasley, 1972, and a book called The Anarchy, The Relentless Rise of the East India Company. Now, those two books are interesting to me because Japan, Abe was actually the first to flag this kind of reference. Japan is attempting to go through a kind of Meiji restoration again, post the lost decade and post the traumatic restructuring of its economy. And what it had to do during the Meiji restoration is going to be no easier than what it has to do now, particularly with the rise of China right on its doorstep. So worthwhile to read those books and get an analog to use. And then on the East India Company, what industrial policy means for the West anyway, rather than the state-controlled economies of Asia, is basically this public-private partnership that we had previously been so careful, not to go too far in that direction. But there was a period in time when we embraced it. The East India Company was basically driving foreign policy and sectoral dominance and supply chain security for the British Empire. And so I think that we're going to go into a phase where the US and Europe and Japan are going to be asking their companies to do a similar thing. And, I think it's not a coincidence that Buffett, for example, bought all the Japanese trading companies. So the Japanese trading companies are in the past were historically the equivalent of the East Asia Indian companies for the British Empire. And the US it has similar companies, but they're much more, the tech companies, which have these gigantic global franchises that can do more than just generate profits. They can actually drive economic and geopolitical outcomes. So I think those two books give you the right frame of mind for the future.
Fantastic recommendations there. Some of them I've never heard before, so I'm going to definitely add them to my reading list. Now, finally, Mark, what's the best way for people to follow your thinking and your writings?
Well, I post everything on Substack now. I have never been much of a writer. I used to post things on LinkedIn over the last 10, 15 years when I had something to say. But LinkedIn has changed its personality quite a lot over the years and become a social media platform. So Substack is where I write. I have the Global Watchtower, which is free and covers like anything I feel like writing about, particularly on geopolitics. And then I have a Dollar Watchtower, which focuses on dollar issues. And I have a BOJ Watchtower, which is specific on BOJ policy.
That's fantastic. I'd recommend people to definitely subscribe to those newsletters. They're very, very good. So with that, Mark, thanks again for the fantastic tour of the world and your thinking. It's been really, really helpful for me, and good luck with all of your endeavors.
Okay, thank you. Thanks. Good to see you again, Bilal. Take care.
Thanks for listening to this episode. Please subscribe to the podcast show on Apple, Spotify, or wherever you listen to podcasts. Leave a 5-star rating, a nice comment, and let other people know about the show. We'll be very, very grateful. And of course, sign up for our free newsletter at macrohive.com. And this podcast is not intended to be investment research, nor does it constitute financial, economic, legal, tax, or accounting advice. This podcast is provided for information purposes only and does not constitute an offer or solicitation to purchase or sell any financial instruments. The contents of this podcast are not based on your individual circumstances and should not be relied upon as an assessment of suitability for you of a particular product, security, or transaction. The information in this podcast is based on generally available information and although obtained from sources believed by MacroHive to be reliable, its accuracy and completeness are not guaranteed. Past performance is not guarantee or indication of future results. Third-party opinions expressed in this podcast are solely those of the speaker and do not represent the views of MacroHive, BGC Group, or any of its affiliates. And this podcast may not be copied or distributed in whole or in part without the express written consent of MacroHive. All rights are reserved.